Okay, this Friday could be a complete disaster for the markets. I mean, maybe we could have some hopium, but it could be a complete disaster. This morning, we got some updates from Marie Daly. She's one of the folks over at the Federal Reserve that always comes to make sure to talk our market down as soon as it goes green. And there are a few things that we got to talk about. We're going to talk about not only this concept of opportunistic disinflation, crazy phrase, and then we're going to talk about what happens on Friday. So first, Marie Daly reiterated how important it is for the Federal Reserve to get inflation to 2%, that this is their job, and that, quote, more rate increases are necessary, and they're going to stay the course of getting to 2% until, quote, the job is done, and their job is 2%. Now they say, look, if there's dislocation in the market, like what we saw with the Bank of England, oh, well, we'll respond too, but don't forget, we're still going to be hiking rates. Like, hey, we could solve little problems that pop up like whacking a mole, but we're still going to be trending towards making sure that interest rates go to the freaking moon. And that kind of sucks. Because see, back in the 80s and 90s, we obviously had extremely high inflation in the 80s. We briefly talked about this yesterday. I just want to reiterate this. And what happened was Paul Volcker ended up raising interest rates so high, higher than the nominal rate of inflation, that we forced inflation down to about 4%. But getting from 4%, like going from high levels of inflation, like 15+% to 4%, took like 5 years. It went down relatively quickly from how high it was. But getting from 4% to 2% took 15 years. And right now, you have a Fed that is doing something they didn't do back then. Back then, they didn't tell us, oh, we're going to get to 2%. Back then, they said, we're just going to get inflation down. And by saying that, by having this different narrative, which is the narrative of, oh, well, we're just going to work to get inflation down. Oh, okay, yeah, 4%, yeah, sounds good. Okay, cool, we're here, we could chill. We could chill for the next 15 years. And what really they did when you actually study the Fed is you'll see that members of the Fed back then, they would say things like, hey, you know, look, we're at 4 or 5% inflation. Let's just wait for the next economic downturn to further drive inflation down, right? They wouldn't necessarily try to like force it down. They would kind of just, once they got to 4 or 5%, they'd kind of just wait. And as opportunities came to reiterate that inflation should trend down, they took advantage of those by riding the market cycle. And so, oh, here's a recession. Okay, great. Well, let's use this as an opportunity to continue to drive inflation down, so on and so forth, right? That's not what we're getting today. What we're getting today is, we should be okay, but in the meantime, we're just going to keep cranking inflation down until we get to 2%, and we ain't stopping until we get to 2%. Now, this is having a positive byproduct, which is inflation expectations are plummeting. Like the market, and maybe we're just being manipulated, right? Like maybe it's entirely possible we get to 4% inflation, the Fed's like, all right, you know what? We've caused enough damage, let's U-turn. Maybe. That could be entirely possible. But right now, they don't make us feel like that's going to happen. And it is having a positive byproduct. The downside, obviously, is the stock market selling off like crazy. I mean, you look at your Webull, where you could get, up to 12 free stocks when you sign up for Webull by going to metkevin.com/Webull. You go over here, and it's just like, oh man, 2% down on the NASDAQ again, and Tesla's down 5.5%, and Ape is down 10%. I mean, this is just terrible. The SPY really is falling 1.64% today. Anyway, so you've got this pain, but it is having this benefit. Look at this right here. This is the chart of 5-year break-evens. And when you actually look at this side over here, look how low those break-evens have gotten. We are well below where we were a year ago. This is when we had the Delta fears. Can you think that a year ago we were just freaking out about Delta? I mean, think about how much has happened between now and last year. Like, just take a moment. Think to yourself, oh, damn, it's been a year since Delta. It's been a year since Kevin ran for governor. It's been a year. And then within this last year, I should say, that we had Omicron first pop up in January. Remember that? It's so wild how much has happened, but it's actually very interesting to see inflation expectations get driven down this much. And the reason, and inflation, like actual inflation, usually follows this chart down, which is great. But it happens with a substantial lag. And the reason we're seeing this is because the Fed is so aggressive right now. Now, don't get me wrong. This isn't to say that inflation expectations, even though they're at the lowest point that they've been in the last year, which could create some disinflationary shocks, it's not to say that we're at the lowest levels that we have ever been at by any means. In fact, we have been at lower levels. Let's go ahead and take a look at exactly the chart when we go back out 5 years rather than just 1 year. Here it is. So obviously during the COVID pandemic, we expected massive disinflation, if not deflation, and so expectations reflected that. That's obviously because, we thought the economies were just going to completely shut down. But if we go ahead and draw a line from roughly where we are now, you can see that we sit here roughly around that December of 2020 election era in terms of inflation. And if we go back, we actually sit right around here in the 2017-18 cycle in terms of inflation expectations, which to some degree was, even though the Fed was still trying to tighten and raise rates in 2017 and 2018, markets freaked out. Inflation expectations plummeted right here in the December of 2018. And just because of that plummet right there, what did the Fed end up doing? Oh, okay, never mind, U-turn. Let's just go ahead and turn the money printer back on. That's literally what happened. They U-turned off of that. Look at this insane plummet we're getting in expectations over here off of the backs of this Omicron raise that we got, the Delta raise, so that's in the wrong spot. Delta would be January. This would be Omicron right here. This would be war. And then obviously we've seen this sort of decline in expectations here. So this is good. Like inflation expectations are being driven down, and maybe they're being driven down by a Fed who's just talking really dirty to us. But the problem is they are being so clear about this, we won't stop until we get to 2%, that they are going to eliminate, or potentially already have eliminated, the opportunity for U-turning before they get to 2%. And that's scary because the Fed didn't do that in the 80s and 90s. Like, they're like, no problem, inflation's down, this is good enough, 4.5%, this is good enough, we can pause. This could be a massive mistake of the Fed, because think about the scenarios. Let's say they start breaking stuff, and then they have to U-turn. Now the Fed becomes less credible than they already are. And now people trust them even less, because it's like, well, you said you're not going to stop until 2%. Now you're stopping at 5%. You must hate poor people, right? Like, that's bad. That the optics of what they're setting up are going to be terrible if they U-turn early. If they don't U-turn early, they could just crush us into a freaking depression. And so then that brings up this topic of, okay, well, what happens on Friday? Well, what happens on Friday is we get the unemployment jobs report. And I'm going to give you the expectations here for this jobs report. And Marie Daly says, hey, look, if this comes in weak, that would be a welcomed piece of news, because right now we think that the futures market is actually wrong in pricing in a Fed pivot. So I'll talk about those jobs expectations, but this is kind of what the Fed pivot looks like. This is the interest rate monitor here. By the way, I got Shopify financials up there as a tab. Boy, we did that in the course member live stream this morning. Which, remember, until I make this transition to actually a Shopify store, which we're slightly delayed in, but we're making it. Until that, we still have lifetime access to the courses linked below. And what's really remarkable is the Shopify financials. They weren't very good, okay? They were not very, very good. But anyway, I was very disappointed with what I read in the earnings call and what I saw in the financials and growth trajectories. I wasn't very happy. It was quite a disappointment. But anyway, so yes, that does mean for a few days we've extended the coupon for the programs down below, and that's totally my fault. Like, I thought it would be much easier to get the Shopify store up, but maybe because their financials are that bad, it's no surprise that it's so hard to get it up with Shopify. So anyway, what's really cool about this Fed monitor tool, I'm just going to kind of bottom line you here a little bit, is what we're actually seeing is the market is pricing in significantly more aggressive rate increases. And they're not wrong to do that, because so far every forecast by the Federal Reserve in terms of rate increases has just been straight up wrong. And so what you're seeing is, take a look at this. This is the probability of basically by next summer of us being at 4.5 to 4.75%. And you can see right after the Fed meeting, this explosion here of that likelihood happening. the more this chart goes up, the more the stock market goes down. And the closer we get, obviously, to that date, the more likely these ranges become. But if I go to, let's say, 4.75 to 5%, you can see this sort of volatility here where the likelihood spikes and then comes down. A lot of the movements we're seeing in the stock market right now are because of spikes and movements in these particular charts here. So, for example, if I go to this is the June meeting of next year, and we look at what are the odds that we could potentially be at 4.75 to 5%. We could see the market priced in a 0% probability for basically all of the prior months here. But as much as on September 23rd, priced in a 44% probability, and now, well, yesterday was pricing in a 21% probability. After comments and reports that we got this morning, when we actually get to data that starts populating for today, we'll probably also see that pop up again. And it's unfortunate, but oftentimes those sorts of spikes lead to nasty candlesticks to the downside. You know, I mean, we had on the 22nd, which was this last little peak over here, 22nd and 23rd. We had a couple strong red days in the Nasdaq, down a couple, probably around 3% in just a matter of 2 days. So you do see how these future rates correlate and expectations correlate with what's happening in the stock market. And unfortunately, jobs numbers like what we saw this morning and the fear of what's going to happen this Friday aren't helping. Like, we keep hoping that the data is going to go down and, limit some of the problems we're facing with the Fed, but we're not. In fact, the expectations for this Friday's unemployment report, unemployment rate to stay stable at 3.7%. Expectation is that month-over-month earnings are going to stay stable at 0.3%. And we're expecting 263,000 jobs. That's down from the prior of 315,000. But the problem with that, folks, is change in non-farm payrolls, 263. It's actually not that high of a number, which means it's going to be, in my opinion, pretty easy to miss it to the upside. I mean, if that report comes in and says we have 300,000 jobs, the market's probably going to tank more because the Fed's going to go, all right, our work isn't even started. Let's just keep hiking. And then you'll see these rate curves change, and then you'll see the stock market get affected. And with the Fed that is eliminating or closing this door to just opportunistic disinflation, which is waiting for opportunities to let deflation go down, and instead they're forcing inflation down, it's gonna be more pain for longer, folks. There's no light yet. It's just more pain for longer. It sucks. Anyway, thanks for watching. We'll see you soon. Bye.